Strategist at Miller Tabak, my best friend. I love this guy. Matt, how are you doing today, my friend?
Doing well, Rodrigo. Great times for the marketplace, crazy times for the marketplace, but unbelievable opportunities. And this upcoming week's going to be another one of those great ones. So, and I don't think really for the next several months, but we got earnings coming up. We got the major averages testing key resistance levels. Whether they break out or roll back over are going to be really, really important. So the next 2 weeks, really, with a lot of earnings coming out, are going to be very important. But this week in particular is going to be a big one.
Well, Matt, look, I mean, I know that you're banking on the chat room every freaking day, but besides that, I really need to ask you because you're definitely the man of the hour. What's going on with the markets, man? Like, definitely people lost. Unfortunately, people have lost trust in CNBC and all these places. You are literally the one and only person that we look up to. So what can you tell us about the markets, Matt?
Well, on one of the things, I mean, on a very short-term basis, anything can happen. I mean, the market could see a little bit more upside here if it breaks, like, for instance, the S&P 500 can break above 3,900. That's going to be bullish on a very short-term basis. But overall, this market's still also has all sorts of problems. I mean, you get, like I said, I mean, so many people in the business have I always say, many of them are paid to be bullish. That's kind of their job. But more importantly, so many of them have lost sight of what's happened in the last decade. I mean, all this Fed largesse, all this Fed liquidity has pushed market way above its fundamentals. And yes, we've taken some of that out, but not all of it. I mean, it's just amazing to me that people are sitting there saying, I mean, at the end of last year, I was saying the Fed's going to change. Is changing policy, no more liquidity, no more lower interest rates. In fact, they're going to raise them. They're going to shrink their balance sheet. The market has to go down because you cannot keep the kind of valuation levels, 22 times earnings and 3 times sales, without major amount of liquidity, added liquidity. And that's what happened. The Fed had continued to have this liquidity long past the, emergency levels of liquidity, long past the time the emergency in the economy had been with us or had ended. And so all of these assets just rallied through the roof because there was no place for this money to go. It wasn't going into the economy. It went to the markets because the banks had all this extra money that nobody wanted to, nobody was lending it out because the economy was already coming along. So the point is that now we have a situation that people are starting to say, hey, if the Fed just throttles back a little bit on this liquidity, like, what are you talking about? We're still at 17 times earnings. And that's if earnings don't come down, and they are going to come down, okay? And everybody knows it. So the point is we still have a lot of evaluating to do in the marketplace. We have a lot of, we have to start, we're just now starting to price in a slowdown in the economy. I think it's going to be a recession. In fact, I think we're already in one, and definitely a decline in earnings. And too many people on Wall Street are thinking, oh gosh, as long as the Fed eases back a little bit, I mean, the market's going to go right back to those what we've been doing the last few years. It's not. It's going to go back to what we did before the great financial crisis a dozen years ago, and fall back into a thing where you're going to have to be able to pick good stocks, where the overall market's going to trade 15 to 16 times earnings. Things like Bitcoin are not going to rally through the stratosphere overnight, although over time they'll do fine. It's going to be a much different market, and people are still trying to assume that what we're going to do is return to what we saw in 2021 when liquidity was off the charts. That's just not going to happen, and we have to be more realistic. But the greatest thing is right now, as this market comes down over time, and I think it's definitely going to, we now have the tools to take advantage of that because we have inverse ETFs. We have weekly options on individual stocks, especially all the big cap stocks and a lot of the mid cap stocks. We have options that expire 3 times a week in the index options. And then we have options on those inverse ETFs we were talking about. We can make money in both directions, downside and to the upside. And the tools are there, which in the past had only been there for the institutional investor. And so this is just, so I guess my point is, this week's going to be very, very interesting. We're going to be watching some key levels in both the S&P and the NASDAQ. If they break above them, there'll be more bullish upside potential near term. If they fail and roll back over, it's going to be to the downside. And then we have a big number of key earnings reports coming out this week. We want to trade around those individual stocks. And I think there's going to be a couple of opportunities, especially in the energy sector, to take advantage of that. So it's a dicey market. It's going to continue to be very, very volatile because Wall Street wants you to think that the worst case scenario is only is something that's going to be another month or two. Then the Fed will reverse things and everything will be just fine. That's not going to be the case. Most bear markets average is about 18 months. They always tell you it's about 6 months, and it's just I don't know where they get these numbers from. Those are the shortest ones. It's those. So we want to take advantage of it, and that's what we've been able to do in the chat room. And I think we're going to be able to do that quite well in the second half of the year.
I have to be honest here, man. I've known you here for about 1.5 years. You've always been on point with everything that you've literally tracked down. So a lot of your members love you because you actually tell them, hey, I think a recession is coming up. We got to fucking, go slim on the stocks. But I understand that you're a very strategic person. So can you help us try to figure out this whole stock place? Share your screen and go from there.
Yeah, great. So let me just, for the first one, you got my screen. Hopefully you can see it there okay. But we'll just talk about what the market's doing right and what I was talking about right now. And then we can we talk about some of the things we've been able to do recently, and then talk about some of the things we're looking at this coming week to take advantage of. But right now, we're looking at the S&P 500. And what I was talking about, remember I said that the market is, I hope I didn't go too far back. Okay, that's too far back. Let's just zoom this in a little bit. And we'll just we'll go to the beginning of 2011 last year. Okay, here we are. Now, I'll get rid of the lines below there, the volume. The volume was higher on Friday because it was an expiration of options. So we'll get rid of that and you can see it better. But look at this situation here on the S&P 500. Everybody last week, it was so weird how people were just, and I understand, I kind of felt that way too with the market. Geez, the market feels really good today. And it's like, this has been a really good week. And the people on the financial news networks, we're all talking about how great the market is and everything's turned around. And I'm like going, wait a minute, it was a down week. It's not an up week. It just felt that way because we opened down on some really bad inflation numbers on both Wednesday and Thursday. We had the CPI, Consumer Price Index number. And on Thursday, we had the PPI, Producer Price Index numbers. The markets opened gap down and we're able to rally back. In each case, they closed down on the day, but it felt like that, we were able to skirt major problems. And I do agree with that. And plus, we did have a nice rally on Friday. The problem is that we still were down for the week, and we still are actually fading back from the key resistance level I was talking about. And here's what we're looking at. Right here, we had a low right about 3,900 in the S&P 500 back in May. And then when we broke below it, that was the support level. We broke below it, and it fell very hard. So as one of the old rules in technical analysis, as old support becomes new resistance, and sure enough, we went right up to that resistance level, got slightly above it, and failed. Then we got up to a second time and failed. Is the third time going to be the charm? We're finally going to break out, or are we going to roll back over either before or after a retest? One way or the other, we should get some sort of we should do one or the other. We should either break out or really have a tough time. So I'm really looking for, I'm worried that we're not gonna be able to break out, but I do leave the opening that we could. If we do, we'll get more bullish and we'll play some more bullish bets. And there's plenty of stocks that have been beaten up enough that we'll be able to play with call options quite well. But the overall thing is just, I want to give an idea of what we're, okay, so the situation really is that we have one. Where can we take advantage of these? And we've been able to take advantage of them all day today. I mean, all year this year. And let me pull up another screen here. Here we go. I'm going to pull this up and to show what we've been able to do. We've been doing it on a very, very consistent basis. We've been able to really get. Let me pull it up here. Only take me a second. But each week, I mean, we do not, anybody who tells you they got a perfect batting average and every one of their trades works is lying through their teeth. Okay. And we've had, I was bearish last week. I was looking for the market to not do very well. And it held in. It held in. A couple of times it looked really good. We made some nice profits on some of our put options that we had bought the previous night. Some of the problem was I held on to some of them too long, but we made some nice profits. And I'll give you an idea right here. Right here. Okay. And this was, and then we also took advantage of the bounces that took place after those, opening declines. Here we were last on Friday. Here we are with the, I'm sorry, it was on Thursday. And remember, the CPI number came out, the consumer price index, higher than expected. The stock market opened down several percent. The night before, we had bought some TQQ calls. Those calls are basically the 3 times leveraged ETF on the QQQ, which is the NASDAQ 100. The NASDAQ 100, of course, has all those tech stocks. And whenever I give my picks, I give very specific picks. I don't just say, you ought to look about, getting long here. Look at some calls on the indexes. They give very specific ones. And here we are, but the TQQQ. So there we had the specific asset. The July 15 calls. So we have the strike price. And then that's the expiration date, of course, is July 15th. And then the 26 is the strike price. And of course, we always say whether it's a call or a put. And this is a situation, we had bought these in the morning when the market, you see, was down. I wish I got the exact low, but we didn't. Whenever, and the thing is with these things, you can't beat yourself up over not getting the exact low or exact high. Because if you look for that every time, you're going to drive yourself crazy because it's all been impossible. So what we did is we bought here these calls, and a couple hours later we sold them with more than doubled our money, 136%. Sorry, 133%, in just several hours. Now we will say that most of our trades don't happen that quickly, where we just make them over a couple hours. We usually make them over several days, at least a couple of days, and sometimes even over a couple of weeks. But the whole idea is what we're trying to do is maximize our returns. We have the bucket of trading bucket of investments that are long-term. They have those long-term horizons, 3-year, 5-year, even longer, where we're looking for those long-term plays, and that's great. But for those who have the time and the inclination to have another bucket where it trades in those shorter term time frames, where you can really maximize maximize your returns, this works out really well. And again, we have the tools to be able to do it. And the volatility this year has been big, and it's going to continue to be that way. And we've been able to make some plays on a very consistent basis. Before I give you a couple of other examples, though, I do want to talk about what I do on the what my background is. And, as Rodrigo mentioned at the beginning, I'm the strategist, the equity strategist at Miller Tabak. Now, most strategists on Wall Street, they're former analysts, stock analysts or economists, and those are fine. But, those people tend to deal in they're on the more long-term and theoretical issues of what's really going on. For me, my background, my first 25 years in the business was in the trading side of things. The first 15 years was at Salomon Brothers. That firm was bought out many years ago. So if you're younger, you may not have even heard of them. But if you know anything about the history of Wall Street, and there's one of the greatest, I think many people think one of the 3 or 4 best books ever about Wall Street was a book called Liar's Poker from the 1990s. And that's when I was at Salomon Brothers, and it took place at Salomon Brothers. We were the biggest trading house on Wall Street for 3 decades. Now, I was there for 15 years, from the 80s into the mid 90s or into the late 90s. And then after that, I was at Merrill Lynch on their institutional trading desk for about 10 years. So 25 years in the on the trading side of things. And when I did it, I covered all of the Fidelity, the biggest mutual fund.
Everybody here, like a quick background, because I know that you have a spectacular background. Like, your resume is 100%. So for those that are just watching here for the first time, if you can give a brief background of where you're coming from and everything else.
Right. So that's kind of what I was doing before. It's just saying that we have the again, 15 years at Salomon Brothers, 10 years at Merrill Lynch, so a total of 25 years. And Sorry, I keep looking away. My dog's walking around here. Anyway, he's great. But anyway, so again, that background, and I cover Fidelity, the biggest mutual fund in the world, BlackRock, the biggest hedge fund in the world, big banks, State Street Bank, insurance companies, et cetera, all these money managers, and you learn about what's going to happen now, not what should theoretically happen 3 years from now or 3 months from now, what's going to happen over the next several days and the next several weeks. And to be able to do that, you have to look at more than just the fundamentals. The fundamentals are very, very important, but you have to look beyond the fundamentals. And that's when you really make some of the best calls in the business. And that's where you make the most money. When everybody's on one side of the boat and they're all either bullish or all really bearish, and you take the other side and you get a big move in the market, that's when you make money. I'm going to show you some examples of what we've done this year. And again, so I'm looking at the fundamentals. Of course, I always have to look at them. To say I don't look at them is of course I always look at them. Very, very important. However, also look at the technical aspects of the market. Again, technicals are based on fundamentals. They're not just a bunch of lines drawn on a chart that some of these fundamental guys, these fundamental only people think about. You just think about it for a second. If you're a company that hasn't been doing much for 2 years, you've been kind of down and out, and so you've had to lay off people, you've had to close factories. All of a sudden, things turn up. Well, sure, you build, so you have to reopen your factory, retool your factory, maybe open a new one, hire new people, train new people. That takes time. So when the business turns up, it's going to take time to really kick in on the earnings side. So if all you're doing is following earnings, you're not going to see it for 6 or 9 months out. But the institutional customer who has an army of analysts, they're going to see that it's happening. They're going to turn to these analysts are going to turn to their portfolio managers and say, hey, XYZ company's doing great. Their earnings aren't going to show it for another year or another 9 months, but I'm telling you, it's going to do well. Buy it now. Don't wait for the earnings to turn up. And then that's why the stocks move early. That's why I always say the market moves 6 months in front of the economy. Stocks move 6 months in front of upturns or in the other direction, downturns. And this is the reason for it. And that's why we use technical analysis, because we don't have 300 analysts that are working for us like they do at some of these big institutional investors. And so we use that. We use sentiment. When too many people are short a stock, we saw what happened with the meme stocks last year. They can get squeezed. There's nobody left to short it. There's nobody left to sell it. So the stock can only go up. Same when a positioning gets too big, too many people own it. I mean, look at Apple Computer last year. I mean, nothing moves in a straight line. In 2021, Apple was one of the best stocks in the stock market. It still saw four declines, 4 corrections. I mean, the stock market didn't see a correction, but the most important stock in there did. We were able to take advantage of those a couple of times. So that's what we're looking at. So sentiment, positioning, fundamental analysis, technical analysis, and pull it all together so we can capture these great earnings. And again, like I said, I've been a strategist now for 10 years, but my background is in the 25 years of trading, not just sitting back reading textbooks like many of the strategists on Wall Street have. And luckily, I work for a firm who doesn't pay me to be bullish. There's one strategist at a major Wall Street firm once said that it's better for job security to be bullish and wrong than bearish and right. I mean, they're paid to be bullish. It's just what it is. Anyway, we'll go into some of these other things we had. So again, we don't just do it in the stocks. We do it in other areas. I mean, we do it in the bond market. We do it in the overseas markets. We do it in the commodity markets, the currency markets, et cetera, et cetera. This is one where we made very nice trade. Just again at the beginning, here we can see this month. And I'll show you. I want to show you examples, not just from this month, from pretty much basically every week in June. Same in May. I could go all the way back to April, but I want to bore you with all those examples. But we can show you how this has worked out really well. Here was a situation where we went long the TLT, July 15 calls. The TLT is the ETF on the Treasury bond market. And so when we came in here, we saw that the TLT, the Treasury bond was getting very oversold, worried about a flight to quality, flight to safety when these things could rally. And sure enough, we came in here and we bought them just over a week ago, midday on Friday. And by 2 days later, we had a real strong rally and we made almost 300%. Remember, 200%, 100% is two times, almost 4 times our money, right? Okay. And just okay, a couple of days. Now, again, we didn't get the exact bottom here. I never claim, I mean, once in a while we do. It's more luck than anything else. If we held on a little bit longer, we would have gotten a little bit more. But when they open up that much and you make almost 300%, I've just said, I'm not going to be greedy. We're getting out, and we made the nice return. And obviously, if we wait a little bit longer, we would have made a little bit more money. If we waited too long, we made a lot less money. And this thing kept going lower as the day went on. And if we even did it here in wheat. Now, wheat is actually the ETF for the wheat is WEAT is the ETF for wheat.
Really quick here, Matt. I want everybody to kind of understand the fact that like you are a global equity strategist, and that's kind of why you're looking at, because everybody's going to be thinking like, okay, so like Matt is looking at these random things all around the world, meme stocks and all this stuff, but you're a global equity strategist. And I think that's like, there's so much value to the fact that you are like, a professional that is looking at these stocks that retail traders look at, if that makes sense.
Right. It's the thing is that, here we had an example of Advanced Micro Devices, a well-known technology company, a chip maker, or you say a semiconductor stock. And we made, you can see here, 146% back at the beginning of June and in the call options in this name. But we also look at a lot of different other areas. And one of them, again, we saw wheat. One time, one of our best trades we've had of all time, we did in the Chinese stock market when we made literally 8,000 times our money in just a day, or just a couple of days. And again, because I'll tell you how and why we went through that process. But again, here's a situation. Just at the beginning of the month, this month, we're in wheat. We was like, who's buying wheat? Do I want to trade wheat futures? You don't have to. We have the ETF. Like I said, we have the tools to take advantage of these. What 10 years ago would have seen incredibly obscure opportunities for the individual brokers. I mean, the wheat futures were only for somebody who were real professional commodities traders. Now we can take advantage of it. But wheat had become ridiculously oversold on a technical basis. The sentiment among futures traders had dropped to just 5% bullishness. So you see, everybody was on one side of the boat. It was ripe for a bounce back. And sure enough, we bought these wheat calls, again, very specific. WAT, that's the ETF for the wheat commodity. We bought the exact strike price, the call, the exact expiration date, the strike price of $9. And sure enough, 250% in just a couple of days. You can see today, that was July 6th, July 7th. A couple of days later, we took our profits, and sure enough, wheat fell out of bed a couple of days later. So it worked out really, really, really well. And then, this thing with the XLE is the ETF on the energy stocks. The group had gotten hit quite hard, and it was actually a good call that I made. And I'm going to see, because we can make money on both sides, and I'll show you that in just a second. But the XLE, you can see now this is moving back into June, where we bought the XLE. Again, these are the energy stock ETFs. The June 30th. That's the expiration date, the $74 strike price. Late in the day, I just saw how crude oil was getting oversold, how the energy stocks were also getting oversold, and I turned very bullish on the group. And then in the afternoon, mid-afternoon, we bought the calls. We bought the $74 calls. You can see we didn't get the exact low, but we did pretty much get the exact high. I mean, I drew it to there, but it was actually a little off the high, but by just shortly. But so instead of 186 that I'm saying right here, we made about 183% that day. But either way, in one afternoon, we bought the next morning. I didn't want to get greedy. Let's get out. These opportunities happen all the time now because the situation is so volatile. Okay, volatility is so high now. Well, look at this one. Earlier in the month, okay, we did the puts. Now, again, I had been actually turned bullish. I was one of the very first people to turn on Wall Street to turn bullish on the energy sector back in October of 2020. And again, everybody would say, "Are you crazy? Fossil fuels are dead." And I was like, no. We can't move away from fossil fuels for at least a decade, really closer to 2 decades. These things are still going to do fine. I knew there was underinvestment in the entire sector, and so the demand was never going to be able to keep. The supply was never going to keep up with demand. The group was wildly underowned. It was overhated. It was a big time ripe, and of course, it rallied 400 or 500% since then. But as we got into, but again, I don't just sit there and keep it analyzing. Actually, a couple of times in the last 2 years, I've taken a negative short-term stance in it. And sure enough, it did the same thing this year. Right at the very end of May and the beginning of June, I said, let's go in and let's walk away from the energy stocks. Don't want to, for your long-term holdings, go ahead and hold on to those. But for your short-term trades, let's lighten up. And then as we moved a couple of days later, we moved into the, I said, the listing's about to roll over. Let's buy some puts in the XLE. So I just mentioned, we just made some money in the middle of the month. We made them in the calls. And then earlier in the month, we made them in the puts. And here's the situation on June 8th. Now, they have the July 17th strike price, but we bought them way back on June 18th. Okay. Again, XLE. So we give you the exact ticker symbol. That's the energy stock ETF. The expiration date, the strike price, whether it's a put or call. Okay. We bought them here at the very end of the day on the 8th. Okay, 2 days later, it rallied quite strong. You can see, 2 days later, 3 days later, it rallied ridiculously strongly of 564%. I said, okay, let's sell half. That's what we want to do. We want to sell half. Then it took a big dip. And I was like, uh-oh, I wish we'd sold all of it. When it bounced back, I said, let's sell the other half. So our average was about a 530% gain on the entire position. But my point is, we make it in both directions because we have the tools to do it, and the volatility is there to enable us to do it. Now, again, I don't want to overbore you with these things. I'm just trying to show that we've been able to do it on a very consistent basis. And this is going to be here's SQQ. This is what is the inverse ETF on the QQQs. So the buying call options in those are a negative bet. But earlier, about a month ago, we bought the June 10th $52 calls. We bought them late in the afternoon. Next day, we sold them with a 400% gain. Okay, and then it was funny. Whoops. What did I do with that? Oops. At the same time, or very similar, we bought some QQQ puts where we made 500% in a day. Okay, QQQ, again, that's the NASDAQ 100 S&P ETF, the June 13th $285 puts. This volatility presents unbelievable opportunities for us, and so we just went. Oops, I keep going the wrong way. I probably apologize. But I mean, again, we do make them in individual stocks too. Now, this is one. It was not even part of the what do you call it? The chat room. I'm sorry, it wasn't one of my picks. It was part of the chat room. But it was not one of my picks. People came in. One person came in and said, the Amazon stock tends to do very, very, very well right before it splits. And they'd already announced the split. And I looked at all the history and I said, you're absolutely right. This looks like a real good play. And then I was like, for whatever reason, I just didn't like it. And I said, yeah, I think you guys go ahead and do it. And sure enough, they did. I didn't. I was a lunkhead and I didn't. And they made, some sold their things a couple of days later with a 500% gain. And 2 days or a day after that, there were some other people held on and has made as much as 1,500%. So these are the types of trades that we've been trying to do. And it's worked, like I said, it's worked out extremely well.
Right. So Matt Maley, everybody knows you from CNBC or Bloomberg. You've been out there. Now, as far as the chat room, besides that, right? Can you please give us a little bit of what do you think is going to happen with inflation? What do you think is going to happen with the Fed? Because there's a lot of talk, Matt, where unfortunately the Fed might not be able to raise rates, and we really don't know. Ultimately, look, to be honest, man, I don't trust CNBC. I don't trust any single news network out there. I talk to you and I trust you. Everybody else that here loves you, all your members look at you at the same way. So can you just give us the truth, Matt? What's going on with CPI?
Well, I mean, the thing about inflation is that they keep trying to talk about, well, we're going to get peak inflation, and that may be true. I mean, but my comment has been for several weeks, if not several months, is so what? I mean, I've been saying, yes, we'll almost certainly get peak inflation at some point in in the late spring, early summer, but it's not going to come down much. And the reason for this is we have supply-induced inflation. They keep on saying, "Oh, the Fed, the Fed's going to, they're going to tighten so much, they're going to overdo it, and therefore the economy is going to slow down." The Fed has been adamant. They've been pounding the table. We are more focused on inflation. We will get inflation under control, even at the expense of economic growth. They've said that. The chairman has said that. The other members have said that. They've been emphatic about it. Okay, and how can you? But the problem is, it's much higher when inflation is driven by supply issues rather than demand issues. People, and the key is, it's the same thing happened in the 1970s. All these comparisons to the 1970s are very good. People say, oh, it's not exactly like the 1970s, and no, nothing's ever exactly the same. And inflation was worse back then, no question, but it was driven by the same thing, supply issues. Back then, it was OPEC. OPEC, came in and cut back on their supply of oil. They said, we're going to jack the price of oil, and so it's like, well. And it caused a recession, it caused stagflation. Why? Because we still need oil. People still need oil. And I always talk about people still need to fill up their cars, and they still need to heat their homes or cool their homes if you live in the hot areas. And whatever the price is, you're going to pay it. But not only that, all these businesses, I mean, everything, every factory running oil, et cetera, these things are essential to the economy. The other thing, of course, is food. Is that food is high. It's going to remain high, even though it's come down somewhat.
Like, how can they bring down inflation if they have no control of it? Ultimately,
exactly.
We're going to have to eat it up, right?
They cannot control it with what's going on with this war in Ukraine, which is a war of attrition now, and is not ending anytime soon. They're not going to squeeze out Putin anytime soon, because guess what? He's selling all the oil he needs to India and China. So he's making plenty of money. They're not going to force him to capitulate. And so that means that all that food out of Ukraine, all that wheat, soybeans, et cetera, out of Ukraine and Russia are going to be much less plentiful. The supplies are going to continue to be constrained. Food prices, even though they've come down, are going to remain much higher than they were a year ago. Oil prices have come way down. Everybody say, oh, look how much oil prices have come down. That's great. It's still 40% higher than it was last year. 40%. Okay. You cannot stop eating. You cannot stop eating. You can't. You're not going to stop heating your home. You're not going to stop driving to the grocery store or wherever else you have to go. This stuff. So if you're spending less if you're spending more on those essentials, you're spending less on everything else. It's just now what has happened, and these people, it's unbelievable. Some people are saying, well, the consumer is still strong. Well, consumers only, yes, that is true to a degree, because they're going into debt to keep their paying up. They can only do that for so much longer. The consumer balance sheet is not strong. Anybody who says consumer balance sheet is strong is out of their minds, okay? The savings rate, which exploded during the pandemic, is back down to the levels that took place during the great financial crisis, okay? So it's at a 12-year low. I mean, and it's only been this low with it. Credit card debt exploding, exploded to the upside. Revolving debt, credit card debt, almost over $9 billion. It's getting close to $1 trillion. So yeah, people are still spending, but they're going into debt to do it. Okay, revolving debt, which is which obviously credit cards are a big part of. That's $1.4 trillion. The real wages, real wages being what people make versus inflation, they've gone down 8 months in a row. Okay. There's no way. You can't have your cake and eat it too. Okay, you can't sit there and say, "Oh, the economy is going to weaken, so the Fed's going to, the economy is going to weaken, so the market's going to go up." I'm like, what? Wait, what are you saying? The stock market. I'm sorry, the stock market is a representative of what's going on in the economy. If the stock market was cheap, I would say that the stock market is not cheap. Okay, as I said at the beginning, we're trading at 17 times earnings right now, but as a lower earning, we're really trading at probably closer to 19 or even 20 times earnings, because as those earnings forecasts come down, people are going to realize that the market's a lot more expensive than it is. Every single bear market in the last 50 years has the valuations have dropped to 15 times earnings. Okay, right. 15 times earnings. That takes the S&P 500 down to about 3,200. Okay, I should restate that to about 3,400. But as earnings come down, it's going to be less than that. So the thought that the Fed can fix this inflation quickly is just wrong. Okay, they're going to keep tightening. They're going to have to do it for a long time, because when you're trying to solve a supply driven issue by cutting back demand, It takes a lot longer, okay? And so this thing's really not going to turn around until we get some sort of resolution with Russia being able to, or either we're able to build back the supply of in some way, shape, or form. And right now, that's not going to happen anytime soon, not in the next 6 months, it'll remotely. So again, saying that hey, the Fed will get it under control. They say, well, and some people are saying, hey, the Fed's going to have to turn around and stop. They're going to pull back on their tightening. Well, pulling back on tightening is not the same thing as adding QE. So the market will still have to, valuation will still have to come down. Okay, but not only that, the economy is going to slow. So so it's going to go down even further. The one thing that will happen, the one thing that could cause them to completely change their philosophy and completely go from tightening back to easing, a new QE program or something like that, will be a major, stresses in the stock in the financial system developing. If that happens, by the time that happens, the stock market's going to be way lower. Okay, that's what happened in 2018. Everybody says the stock market went down 19%, so the Fed tightened. They did not. That's not why they tightened. The market was down. They kept tightening. It wasn't until there was major stress in the fixed income market, and the fixed income market is what makes the financial system work.
Right.
That's when they change. So relying on the Fed here, the Fed is actually doing the right thing. They're causing the pain that is needed, but people don't want to believe that. They're like, oh, we're going to have to go through a series of this. It's going to take time, and we're going to take advantage of it.
Right. So Matt, let me ask you something. I'm 30 years old. All my life, I've been hearing about this debt ceiling that keeps going up and up and up and up and up. So as a millennial, I feel that honestly, we're getting stacked with all this fucking debt. I'm sorry, but like, what do you think about all this debt that keeps stacking on? Like, how is this going to end up at one point? It can't be forever, right?
Well, I mean, that's one of the other big things. And I mean, it's one of the reasons why we have to worry about inflation. I mean, there are some people who would argue that the Fed purposely kept the liquidity spigots so open for so long last year because they wanted inflation. And why do they want inflation? And they want inflation, again, they don't want crazy inflation, but they want to keep it high, okay? And the reason for that is because it's the only way you can get out of this debt. We're in a debt bubble. Like you said, we just keep on. We have $11 trillion in corporate debt. Forget about the government debt, $11 trillion in just the US, okay? We can't go through another, you can't just unwind that, okay? The only way out of that is to inflate your way out. Sorry, there's two ways out of it. One of it is by major defaults. And if you get major defaults, you got much bigger problem than inflation. So you have the lesser of two evils. The Fed has decided on the lesser of two evils, which will basically make inflation will help us inflate our way out over time, but it's going to take a while. Inflation is going to be with us for a while, I'm telling you. And it's not going back to, believe me, it's never going back to, say never, it's not going back to 2000 to 2%, like they say their target is. They're going to raise their target eventually to 3 or 4% because we need that inflation, all right, to inflate our way out of this bubble that we found ourselves in. And that's the only way out. So you better get again, I'm not going to say that we're going to have a crazy inflation like we had during the 1920s in Germany, but this is a situation that is going to be with us for a while. It's going to constrain growth for a while. It's going to cause valuations to come down further. And once it happens, which is going to take some time, then we can go back to what we were doing and just and concentrate a little bit more on those fundamentals. Technicals will always be very helpful, but the situation with too much debt is cannot go on forever, and it can't keep going. The Fed realizes that, so now they've decided the way we're going to do it is to inflate our way out. And in my opinion, that's why they purposely kept the liquidity spigots open longer than they would have last year, because they wanted to create this inflation because they needed to. So, again,
well, let's get into, show us how you can actually profit from these trades, Matt, because regardless of what's going on in the economy, look, we can complain all day, man, but at the end of the day, you profit from stocks going up or down, right?
Exactly. And that's what, we look at these situations because we get these wild swings. I mean, we're just going here. Let me just go back to this other thing we had. again, sometimes it's in the U.S. stock market, sometimes it's in other stock markets. Here we are. Whoops. There we go. Earlier this year, back in March, this was our biggest trade. Whoopsie, what the heck happened? I don't know what that is. Oh, I'm sorry. I pushed the wrong button. Hold on. There we go. And this was the, again, it wasn't this weekend's chart. It was this weekend's chart when I made it back in March. But excuse me, we have the, again, the FXI, that is the ETF on the Chinese large cap stocks. I knew this, there was a good reason why this turned down. It was the Chinese government had been cracking down on all these different industries. Every month they picked a new industry, cracked down, and they started with Alibaba back in 2021. I'm sorry, back in late 2020. But then they went to, whether it be gaming, other technology areas, education, et cetera. They just, every single month, there was a new one. The stock market slowly, gradually, but harshly, got hit pretty good. Then at the end, in the first quarter of this year, the U.S. government came in and said, "Hey, we're gonna change things, and we're gonna delist a lot of these." Or I didn't say they said they would, but they might delist some of these Chinese companies. And the thing just fell out of bed. And look at this RSI chart. This is what's called a relative strength index RSI chart. Look how oversold it became. Every time it got down below 30 here, it was a great opportunity to buy. You see here was an opportunity to buy, rallied there. Here, saw a little bit of a rally. Here, saw a nice little rally, etc. Look how oversold it became there because of this new news out of the US, maybe delisting all these stocks. And I just said, this is crazy. It's the most oversold reading ever for the FXI. On the technical side, and then on just experience side, I knew that the Chinese government would come in and support their stock market because they just can't let it go down like that to save face. So we came in and we bought those. And sure enough, the next day, so we bought that the other day. We bought some, and I'll show you in a second, the FXI call options. Well, look at that. The whole market rallied 27%. 27%. That'd be like the Dow Jones Industrial Average rising 27% in just one day. But, and so what we did, we had bought, remember I said that we had bought on the 15th, the FXI, March 18th, $30 calls. The next morning, they were up over 1,000%. I didn't sell them right away. I said, well, I thought you said if it opens strongly, you always want to avoid getting greedy. Well, I do, but again, I knew that the government would keep buying. And so when it got and then by mid-morning, it was up almost 3,000%. And I said, okay, we can't get greedy. We got to sell at least some of it. So we sold half here. Then at the end of the day, it was up almost 8,000%. So we had an average of about 5,000% that day. And some people even held it on to the next day and made as much as one person made, they said 14,000% on their money. So it'd be 5,000%, whatever. This is what we were able to make. And these are the types of things you can make when there's the volatility that much, because so many people, it's such a herd theory. So people just get, everybody on the financial news network say, oh, you got to hate China. It's uninvestable. Remember that? They were talking about it being uninvestable. I heard that. I was like, it's oversold. It's overhated. The Chinese government's going to support it. And we got people on CNBC saying it's uninvestable. Okay, and untradeable. And I said, that's the bottom, everything. And sure enough, we made huge money. So that's really, the type of things that we try to do when the situation arises. Now, and of course, like I said, we try, I show what we did in Amazon. I show what we did in Advanced Micro Devices. We had, and I'll show you here an example where we took one stock, a key stock that everybody looks at, Apple Computer, and we also took Bitcoin and what the situation was going on in Bitcoin, and we're able to kind of tie those together and make some really good plays. Now, of course, everybody cares about Bitcoin right now, so let's just look at it. Oops, sorry. Okay, oops. We'll just look at the RSI chart that I told you before. Boom. Now it's trading this sideways range, so we'll talk about what I think about it right now in a second. Actually, we'll talk about it now. But then I'll tell you about what we did in Apple a couple of weeks ago after that. But because everybody cares about Bitcoin right now, and maybe not as much as they used to, but they will. Now, what we got to do right here? Look at this thing. I'm going to get rid of these lines up here are moving averages. Okay, the 100-day, 200-day, and 50-day moving averages. I'm going to take those out. But look at this. What happened here in this thing? We had a nice little rally at the beginning of the year. But since it's gone down, it got caught in a kind of a sideways range, and then it just couldn't get going, sold off hard. Okay, so it went from 20,000 to 40,000. Then we got caught in a sideways range. Again, this was riding right around 40,000 for almost a full month. Now we've been doing the same thing for about a full month, riding the $30,000 average in the spring. Couldn't break out, fell off. Now we're riding the 20,000. It gets a little bit more movement, but we're still kind of riding that 20,000 area. And what I'm worried about is that we're going to get another leg down. Now, if it can break out, it'll be good. But look at what's happening here. And this is what's called, again, we like to do a lot of educational stuff. A lot of people were not familiar with the MACD charts. It's something that the institutional people look at all the time. And this is what's called a MACD chart, okay, down here. And this white line is the 9-day moving average, and the red line is the 12-day moving average. And so what we do is that whenever it's you know, I'm sure a lot of you have heard about the golden cross and the death cross. The golden cross is when the 50-day moving average crosses above the 200-day moving average. That doesn't give you a bottom in itself, but it tells you that the momentum has shifted to the upside. The death cross is the exact opposite. When you see a 50-day moving average cross below the 200-day moving average, that's a death cross. That confirms that it's turning down. Well, look at what has happened here this year in every time it's seen a death cross. See how again the white line traded below the okay, I'm sorry, should I say this? So those are death crosses and golden crosses. In the MACD, it's a shorter term thing. We have the 9-day moving average and the 12-day moving average. These are actually exponential moving averages. But either way, you see how when the 9-day crosses below the 12-day, see how it's sold off there? And then as we moved into this year, again, we sold off here, another negative cross here. And look how far that sold off. Okay, then another one here, sold off. And we're very close to another one. I haven't gotten there yet, so I can't pull the trigger, but I'm getting very worried that this is going to happen again. So keep an eye for those who care about Bitcoin. Again, look right now it's at the upper end of its sideways range. So maybe we'll get a surprise. Maybe we'll get a nice upside move. Like I said, I'm still be watching some of these things on the overall stock market. If the stock market can move higher, there's a good chance that we'll see some upward movement in Bitcoin as well. So keep an eye on that. If, however, it rolls back over, watch that MACD chart, because if we get across, and it has to be more than just a little bit of a cross. See right here was a little bit of a head fake, kind of bounced around right there. But when you get that known crosses, it definitely coincides with a strong decline in Bitcoin. So I'm worried about Bitcoin right now on a near-term basis. Longer term, I mean, and just the whole cryptocurrency situation. The cryptocurrency asset class. The ones that survive will do very, very well. But other people have said this, and I agree with them. I don't like to be in the consensus very often, but the consensus is right when they say that Bitcoin and other cryptocurrencies are going to be a lot like the internet stocks of 25 years ago or 20 years ago. The ones that survived did wildly well, and I think that'll be the same case. I mean, Amazon obviously did wildly well, but Amazon went down 90% during the dot-com crash. Now, I don't think Bitcoin is going to go down 90%, but it's still because we still don't really know how to value it, and the biggest thing is that a lot of its success, its outside success, was due to the huge amount of liquidity that was being provided by the Fed and other central banks. Everybody just said, "Oh, this is because I'm so smart," and it's going to change the world. Yes, but it's not going to change the world overnight. Just like Amazon didn't change the world overnight. And Bitcoin is going to be like Amazon. It's going to be a lot higher, or that, and Ethereum and a couple other of these names are going to do very, very well over time. But that doesn't mean they can't go down go down further. And so I'm concerned, because I do think that we haven't washed out all of the froth. We have washed out a lot of the leverage that was in the cryptocurrency. So I'm not as bearish. Jeff Gundlach, who's incredibly successful fund manager, a hedge fund manager who is known more for his bond prognosis, but bond investing. But he says that Bitcoin could fall to 10,000. I'm I'm got more of a $14,000 target right now. But he's a very smart guy, so maybe it could fall that far. But the point is, I do think it's probably going to go lower because we do have to get it back down to people got so excited simply because it was going up. Because it was going up, they drew the conclusion, hey, Bitcoin is going to be taking over the world within a couple of years. It's going to take a long time. So we need to be careful of that.
Right. And here's the thing, Matt. So, I mean, you're from Boston, right?
Yep.
I'm from Nicaragua. It's Central America. And I know the, how do you say it? Like the president of El Salvador, he's trying to give people Bitcoin. They don't even have Wi-Fi. Like people in El Salvador barely have Wi-Fi. So like, honestly, from like a strategic point, right? From as an analyst, to like just 100% honestly, you see this stuff happening, you see Bitcoin, you see what's going on with Celsius, you see what's going on with Voyager, all these regular people that have their money frozen. And I mean this really from the bottom of my heart. I feel really bad for these people because their money is gone, 100% gone. A bankruptcy, it's a pretty tough choice. But I just want like people to really understand, Matt, because even though we love Bitcoin and all that stuff, at the same time we have to help our viewers and viewers to
Right.
really be careful about the stuff. And I feel that you are the perfect person because you've seen these fads. You've seen 100 fads. You've been doing this for 40 years. This is your thing.
Exactly. And it's like, the new economy that heard the late 90s, the new economy. And that was liquidity driven too. I'll tell you a story that a lot of people don't really realize, and I don't want to take up too much time, but just to say that there was this thing called Y2K back in 2000. I'm sorry, the late 1990s. And what it had to be was that what it had to deal with was that all the people that programmed computers in the 20th century, it would just be two digits. 1989 would be just 89, and then 90, 91, 92. The problem was that the computer, when it got to 00, was going to think it was 1900, not 2000, because it just automatically had the 19. So all the people had money and banks and everything else. It's like, oh, yeah, you'll have just as much money as you had in 1900, okay? Which, of course, nobody was alive in that. Well, most of the people weren't alive in 1900, and those who didn't have very much money. And so it's like the whole system was going to crash. Luckily, they knew this well in advance. But and so many years in advance, like 8 or 9 years in advance, they finally started working on it. But what they did, what the Fed did, and what other global central banks is, they flooded the system with liquidity, just like they have recently in the last year through QE programs. They did it through other means back then, because they wanted to make sure that people didn't start panicking about losing their money and go to the banks and say, "I want all my money now," because because I don't want to lose it all. And so luckily they spent enough money. All these corporations, the Federal Reserve provided enough liquidity. All these corporations spent billions of dollars to fix this issue, and they did. Okay, and it got fixed on time. And guess what? A month and a half after the year 2000 started, and everybody realized, yep, we did fix it. We gave it a couple of weeks. Everything's fine. We got all these computers jiggered to recognize that it's 2000 and not 1900. Guess what? Liquidity disappeared and the market went down. That's what's happened this time around. We had all this liquidity, and the market's turning down, and it's gonna be a rough, just like it was in 2000. It's gonna be a rough 2 years, maybe 3 years, just like it was back then. Not as rough, I don't think, but rough. So you got to be able to avoid some of these things that are real big problems. It's Coinbase and stuff. It's just you put too much money in one area. I mean, you put too much money in a bank, you have the FDIC insurance, you're going to get that money back. You may not get it back immediately, but you're going to get it back. These people have lost it. It's gone. And there are many of these. I guess there's just too many unscrupulous people on Wall Street. That's been the case for 300 years in the U.S. and for hundreds, if not thousands of years everywhere else. You just got to be careful, these people. And some of them are well-intentioned, but they get in over their heads, but it doesn't matter. You've got to be able to be careful. There's too many people have too much based on everything going higher. So they're constant, oh, stay in, stay in, stay in, because if you leave, you'll cause my stock to go down, or my job, I'll lose my job. And they're not really telling you exactly. They're not as truthful as I don't want to say. I'm not saying they're lying, because stock markets do go up over time. I mean, that's all, we know that. But when you get situations like this, you got to be very, very careful. And we've been able to, help people this year. I mean, our portfolio is up, up quite a bit this year, and we've definitely had some losing trades, had losing weeks, but we've made a lot more money than we've lost, and we have an up year. Many people have up years this year, and so it's really turning out to be the type of year that will really, and I think will continue to be for a while, where you've got to be very, very careful and be up on not just the fundamentals. You've got to be up on what's really going on in the world, not what these guys are telling you, like everything's okay as long as the Fed pulls back a little bit. It's basically what these people are telling you, okay, is that they're telling you is that they're telling you what happened in the last several years. We were on major league steroids, okay, and so we could do anything. We could lift all sorts of weights. We could do whatever we want to do. We could bench press 500 pounds because we had all the steroids. Okay, now the steroids were taken away, so we can't bench. Even though people are very strong, it's like I can still bench press, but I can't bench press 500 pounds anymore. Somehow people are trying to convince you that, where even though the steroids are being, so we've taken away the steroids. We're not going to take them away as much as we used to, but you're not going to have anywhere near as much as you had. So you're not going to be able to go back to 500 pounds, bench pressing 500 pounds. When you go from steroids being not only added, then they go down to, now they're here. You just go back to here. The market doesn't go to here. Okay. We are not going to have steroids anymore. Right. So the stock market is not going to go back to doing what it did in 2021. Okay. So that's okay. People may not want to hear that because 2021 was a great year to be long, but that's not happening. So, I mean, you see it from time and time again. These guys with the private equity area saying there's a lot less money for us. Why? Because there's all the liquidity lying around. That's why. Why do you think all these technology companies are laying off people, right? Why? Because they know they've got some really smart people from these startups who are going to be out of jobs soon, and they're going to. It's like even because people say, well, we're going to lay off now, but we're going to keep our employment steady. And why are they going to do that? Because they're going to poach all these people from the startups who are going to go out of business because they won't get the money to stay in business. Okay, so yeah, maybe the really best technology companies will still hold right. Okay, but the overall employment level is going to go down. So again, I don't want to get too much into the weeds on that, but the point is that we are not returning that.
We love your insight. We definitely, everybody here loves your insight, Matt, because honestly, you are one of the few people that are very honest about what's going on. And I know that, this is what you've been doing for all this time here with the chat room.
Yeah, and it's great. And the thing is, in the chat room, we get so many people talk about so many different things. There's times where somebody brings up something where we have this great group of people who are bantering back, whether it be ideas about stock picks, but looking at certain issues. Say, hey, have you thought about this? Do you realize that? We have people who are talking. I mean, it was great commentary from somebody who grew up in Eastern Europe and lives in Eastern Europe, and saying, hey, Putin isn't giving up. And he gave us this thing about Putin giving up. That's not happening. It was just a great commentary. So somebody was there, and we all learned from it. I mean, I was already of that opinion, but he just somebody was actually living there and lived and had been there for many decades. I mean, in other words, he grew up there, but my point is, he wasn't just a 19-year-old person who's just kind of learning about things. He's seen it for many decades, and he was very, very concerned. And so we learn from each other and banter back and forth about what's going on in different parts of the world, different parts of the industries. And again, a lot of these people, hey, I work in this industry. I'm in the restaurant industry. This is what's happening here, and it's just a great opportunity to learn from each other, because you're not going to get the BS that people do, because they have. I mean, let's face it. Some of these people, they have say, they're going to say something negative about one of their big advertisers. Probably not. I don't have any advertisers, so we tell it like it is.
I think that's really something very important to highlight, Matt. The fact that you are, well, number one, and this is an issue, and I don't want to make it an issue, but people don't trust the media, unfortunately. People trust you because number one, you're Matt Maley, you're, and ultimately all your members love you, but this is a problem. This is a problem. People don't trust the media. Ultimately, we're traders, right? We're here to make money. That's our goal. That is literally why we're here. How can you help people kind of like sit through all that stuff?
Yeah, that's what I'm constantly trying to do. I mean, we talk about, but again, there's a thing that came out where they had somebody coming in on one of the financial news networks. It was, somebody they were interviewing from Wall Street, saying that, um, the consumer's balance sheets are in great shape. And I was like, and one of the people on the website said, what do you think of that? And I tore into the price, like typing quickly. I was like, are you crazy? It's again, the consumer is spending, but the only way they're doing that is by going into debt. So their balance sheets are deteriorating dramatically. The only reason why the balance sheets seem like they're okay, is because home prices are still staying elevated. Yes, home sales are starting to come down, housing starts, things like that starting to come down a little bit, but home prices are still staying up. So people's homes are worth a lot more than they were a couple of years ago. So their balance sheets seem okay. They still are down because stock prices are way down, and because they've added way more credit card debt, way more automobile debt, etc. But the thing is, it's like, well, if the consumer's balance sheet, first of all, they're saying it's here, it's great. It's here, but in many ways, it's really here. Why? Because what can you sell in your house to pay for a vacation? You own some stocks. You can say, okay, I'm gonna, oops, we have a little less money than I thought we are gonna have, but I can sell some shares of Apple, and that vacation we've got planned, we can still go on it. Well, you can't sell off 1/10 of your house. As I said, I'm going to sell off the chimney so I can go on vacation. No, it's not liquid like that. You either hold it or you sell it. Okay. And, of course, you can't take out a second mortgage, but that just puts you more in debt. That deteriorates your balance sheet. So if you take away that, so first of all, it's not great as it is, because all this credit card debt, all this revolving debt, and the wage growth, I'm sorry, the real wages going down. Okay. So it's down here, but it's really down here because homes are not liquid. And besides, home prices are going to come down a bit. Now, if you have to sell your home, that's not a great thing either. So it's just, they say these things, and I'm like going, how can they possibly say so? I mean, don't get me wrong. There are things we can always look, whenever the markets, no matter how good the market looks, there's always something bad that is truly going on that you can point out. If the market's really doing horribly, there's always something good you can point out. So I'm not trying to say that everything stinks, but boy, some of the things that people point out, like great balance sheet by the consumer, is just nuts. Because, like I said, the savings rate, okay, the savings rate as a percent of disposable income is down below 6%. That's the lowest it's been. You have to go back to the Great Recession, when the great financial crisis of 12 years ago, to see it lower than that. When people have that little low savings rate, that's not good. And like I said, people like to throw in somebody's house as a level of savings, but that's what they're saying for retirement when they sell that big house and buy a smaller one in Florida or someplace, not something they can use to pay for college and
Right.
Other things.
Matt, can you expand a little bit on that? Because a lot of people unfortunately watch CNBC and, they think that savings are at an all-time high. Is that true? Are people really, do people really have all-time, I already know the answer, but are people really all-time high savings? Seriously.
My reach here. I just want to pull this thing up because I just want to pull, I have these, I'm going to pull it up because I can never remember I have a little card here that it's kind of funny, an old card.
Really quick, folks, really quick, folks, just for you guys to know, Matt Maley has the #1 record for the top percentage trade. #1. He had it was 10,000% on FXI. Before that, the record was held by Matt Maley. So despite Matt Maley being very, 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 very smart, I'm telling you that Matt has some good tricks and good trades up his sleeves.
Right. So here's this this number Just talking about, and yeah, I did show them that FXI trade earlier, where we made, basically, 4,000 and 8,000%. And I'll show you the other one, which was the old record. But let's go. So here's the savings rate. This is the U.S. You can see up here it says U.S. personal savings rate as percent of disposable income. Yes, it was very, very high. Look at it now. It's back down to 5%. I mean, you can't. It looks like it's the same here. It's actually a little bit lower. Okay, but you have to go back at least 10 years, and really to find it lower, you have to go back to the Great Recession. And so, how can people possibly say that savings rates they're just making it up? What they're doing is they're using the home price, the increase of home prices, to make it seem like it is when it's not. And you can't. Homes are not liquid assets. You can't use them. And 64% of Americans live paycheck to paycheck. Okay, so they need. They're not relying on savings anyway. So it's come way down. We need to be very, very careful. But to go back to your question or your comment on the on these picks, I mean, you mentioned the FXI, but the again, I told you, remember we bought that that option. But I'm going to go over here and let's move this over here. There we go. This was the one. This was the old record we had. This is Viacom. Now it's now, Viacom, they've changed their name to Paramount because they split off. But remember I showed you how ridiculously oversold the Chinese stock market become. This was Viacom in 2021. Okay, look how overbought it became. Again, this is these relative strength index are great indicators. See, when they get below the green line, that's below 30. It's a good opportunity to buy, and that's why they have a green line. Go ahead, buy. That's a good level. It's oversold, and on the red line is above 70. That's sell, stop mine. Don't buy it up here. Sell it. And sure enough, you see how when Viacom got to these levels, got up there, stock sure enough fell shortly thereafter. Look at this one though. In the early 2021, it not only got above 70, it got to 95. So right here, I said, okay, we're going to buy some put options, and sure enough, the stock went down 60% the next day. This thing ran up because of a short squeeze. It was a part of the whole meme stock craze. Everybody was looking, it was GameStop and AMC. What other stocks have big short interest in it? Viacom was one of those names. And I'm like, I don't care. When a stock rallies that much, especially a company that's been around forever, I mean, if it's a new company that's going to change the world, yeah, I can see why it would go up that much. Viacom's been around since before I was born, CBS, et cetera. So this thing came down. We made 5,000% on our options. So these are the types of things. Now, these huge ones where we make multiple thousands of percent are they're once a year, maybe twice a year. We might get another one, and we might get one this year. You just give it all the volatility. But the point is that one second. Oops. Okay. Good. Yeah, it's just the point is that we have. Okay, yeah, this could be a good one here. The point is that we get these great opportunities, and once in a while, but we get a lot of other opportunities that are that are more than just a couple of just making 50%. 50%. That's great. But look at this. We were talking earlier. Remember I said about how how Bitcoin and what was going on there. Well, back in June, when the thing was just back in May, when Bitcoin was really falling out of bed. And it was dropping from 20,000 down to 30,000. And I said, and I just looked at it and I said, Apple went down 10% in just a couple of days. And I was like, what's going on? There's no negative news on Apple. And it's like, Apple doesn't go down 10% unless there's some sort of new news. And it's again, this is not one of those brand new tech companies that can fly all over the place. It's Apple Computer. But then I remember what was probably going on, because I remember what happened with long-term capital management. And Bitcoin got hit. People couldn't sell enough Bitcoin to meet their margin calls. So what did they do? They sold their tech stocks. What's the most liquid tech stock? What's the stock that they could raise the money they needed to raise? It was Apple Computer. So finally, when Bitcoin stabilized for a day, Apple kept going down. I said, the margin calls are ending on Bitcoin and the other cryptocurrencies. Apple is going to bounce back, because the only reason why it went down was because it was being used as a source of funds to pay for Bitcoin and other cryptocurrency margin calls. Sure enough, we came at the end of the day one day, we bought the Apple May 13th, $143 calls. We bought them on Thursday, the 12th. Sure enough, they rallied at the end of the day. The next day, they were up 414% when we sold them there. Again, if I'd held on longer, we would have made a little bit more money. But I just thought at 400%, we just can't be. We just can't be. Especially, we saw this dip here. How many more dips are going to get? 400%. Move on, and I'll never lose an ounce of sleep. I take 400%. If it goes up 450%, well, I don't care. I just can't worry about that. But that's the things that we're constantly trying to find in the marketplace.
And just for everybody to kind of know, Matt Maley, you are Mr. Volatility. And for some reason, at first I found it hard to believe, Matt, but like this is your thing. Like you love volatility, and it's not normal. People don't like it. People just want to stay away from it. And I get it. People want stability in their lives and stuff. But at the same time, I'm looking at you and you are just killing it every single week with these calls and puts. So ultimately, everybody wants to trade like you. Everybody wants to buy calls, buy puts, max profit, minimum loss. But at the same time, they don't have 40 years of experience like you do. You've been doing this, just for those that don't know, you've been at, Solomon Brothers, right? Merrill Lynch, Miller Tabak. You're on CNBC every freaking day, right? And the good thing, and for those that don't know, and maybe I can get in trouble for saying this, but Matt is very honest, and Matt ultimately cares for his users, and not everybody can do that. Maybe you can expand on that, Matt.
Well, I was on last Monday with Brian Sullivan on CNBC, and he's like, he said, well, he just said that, he says, well, one thing we can count on you is that you're brutally honest, and that's why. And Brian's is a good.
Brian, he's a cool guy. Yeah, he's a cool guy.
So so that's that's what we try to do. I mean, it was kind of funny too. I did get a call from another financial, but again, it was not for an interview. It was not for an on-air interview, but like I do with CNBC and Bloomberg TV and Yahoo Financial every once in a while. Sometimes TD Ameritrade has a network as well. But for a print media person, and they asked me, and they were like all excited about the tech stocks because they're bouncing back. And I said, yeah, they could be okay, but look at these other issues that were negative. And this person did not. I mean, it was just like they were there to hear something bullish. That's all I wanted to hear. And I said, listen, if that's what you're looking for, again, I can see this short term fine, but you're looking for somebody to tell you that we're seeing the absolute bottom in tech stocks. I'm not that guy. If that's what you're looking for, you should talk to somebody else. And they're, obviously, we had a very nice conversation, and great professional, but needless to say, I did not get quoted in her article. And again, there's nothing wrong with wanting to. There are reasons to think that maybe the tech group is finally bottoming here. I just don't see it, and there's just too many reasons to think otherwise. And so I just try to be honest with people. It's not always what makes you the most popular guy around, but
everybody loves you for that, because to be honest, Matt, you were there could have been 1,000 people. Ultimately, the only people that I care about are my users here, people that are your members, right? From the Stock Picks Inner Circle chat room, or people from the Tier 3 chat room. They all love you. You were the first person that was saying, I feel that there's a correction coming, go light on cash. And for some reason, CNBC is always like pumping stocks, it's always going up. Yeah. But ultimately, your members have been, let's just get it out of the way, folks. Matt's chat room has the highest P&L of every single chat room in Benzinga, for you guys to know. Matt he's on top of all this stuff. So let him know, Matt, why you are. I already know. I've known you for a year and a half. I've been following your picks. I've been here for a year and a half. I've always been trading your picks. I love them. I know that you have a strategic point from you. You're a trader, you're an analyst, you have all this stuff. And I like it because ultimately I trust you more than I trust any single news outlets out there, right? So
well, yeah, it's just, again, you just got to know what they're. In some cases you have some people that are very flamboyant and entertaining, but I don't know that that's always the best giving the best advice all the time. And don't get me wrong, again, the these financial news networks are very, very good at getting really good people out there. You just got to make sure you know which ones are what they're doing. What are they selling you? Trying to sell you something, or are they trying to tell you, give you the honest, what they're really thinking? I mean, sometimes it's funny because people just say, there's a term that you say, the person's just talking their book. In other words, that person's just talking bullishly on Apple because he or she owns a lot of Apple. Well, true, but they own a lot of Apple for a reason. So it's okay. It's okay to talk your own book if that's really what you're doing. If that's really saying, hey, I'm telling you what I like. But if you're talking your own books to pump up a stock so you can sell it, that's a whole different thing. And there's some people who've been accused of that over the years. Again, these things can be very helpful. But if you're looking for truth, that's kind of my, what I'm trying to, there's times, and again, it's like I was very, very bullish on the energy stocks for an extended period of time there for 18, 19 months. And then I just saw the thing had gotten run too far, turned bearish, and that worked out very, very well. So I was like, I didn't have any constraints. I didn't have anybody telling me, no, don't turn bearish, don't be concerned. Just do what you think. And that's what I try to do. I mean, I'm not right every time. I've certainly been wrong at times in the past. And of course, one of the big things is that you have to do is that when you see that you're wrong, change. And if the facts change or your interpretation of the facts finally change, and that's what technical analysis helps us so much. But yeah, it's just a lot of people who are. There's nothing wrong with saying the market's going to go higher over time. It will, and that we are going to get an unbelievable buying opportunity at some point. I just think it's going to start at a lower level in the next 6 months. And those people who keep telling you to stay in it. At the beginning of the year, I was saying raise cash, as Rodrigo said, raise cash, raise a bunch of cash, not just 2 or 3%. Raise a bunch of cash. This market's going lower. I've been saying all the way down, and now finally other people. And I've said bear market. And I did at the very beginning of the year, I said deep correction by late January, February. I said bear market, recession, etc. All these other people, they say it after it's already there. I mean, you get people saying, well, yeah, we could drop to 3,600 now. I was like, well, where the heck were you when the market was at 4,800 and I was saying 3,600? So
you were the only guy, and I remember, Matt, literally talking about Robert Nadella, Microsoft CEO, selling 1/3 of his stock. You were the only guy talking about that.
Right, and that was, for those who haven't heard about that, Sergeant Nadella, who's the CEO of Microsoft, and he is a great CEO, and he did nothing wrong. He did nothing unethical. He just accumulated a lot of stock in his time as CEO, and he turned the company around over the last decade. Did an unbelievable job. But he saw that his stock was getting way ahead of itself. It was very expensive. It wasn't crazy expensive like some stocks, but it was expensive. And more importantly, I don't know this for sure. I'm thinking this is what he saw. And then he saw that the Fed was announcing, hey, we're going to get much more restrictive. He saw the valuations weren't going to hold up. And he sold 2/3 of his holdings, $374 million right at the top. As I said, too many times when you see an insider selling that kind of size, that means he or she knows that the market, the stock is going to go down, not just go down, it's going to stay down for a while. I mean, he's seen plenty of 10 or 15% corrections or even 20% corrections in Microsoft. But he wasn't worried about it because it came back. This time he said, nope, I'm selling big time because I know the stock's not getting back to this level for a couple of years. Doesn't mean Microsoft's going out of business. It has nothing to do. I'm not saying anything negative about the company. I'm just saying something negative about the stock. And when a guy like that sells that much, and again, people heard me speak before, probably tired of me hearing me say it, but when insiders sell, the partners at Goldman Sachs, after being private for 100 years, sold in 1999. Why? Because they sold their company, took it public. Why? Because they saw what was going. They saw the bubble and they got out just before the top. BlackRock, the same thing. This big private equity firm, summer of 2007. They had been a private company for 25 years. They sold to the public. Why? Because they saw the bubble and got out. They saw the financial crisis coming, and they got out 3 months later. The stock market topped. Sam Zell did the same thing. He didn't take his company public. He sold it to another company, but he's one of the greatest, billionaire real estate investors. He sold it right at the top. People don't sell their whole company or big chunks of their positions. Those guys at Goldman Sachs didn't sell all of their positions. They still own some of the stock, but a big part of it, they don't do that unless they see a problem. I was pounding the table on that from Thanksgiving when he made that sale all the way into the end of the year, saying Microsoft, and of course it hasn't, the guy saved close to $100 million by selling when he did. Now he'll get more stock, each year he'll get paid in certain amounts. His pay will come in stock. But these are the types of things that in my experience help me see and capture. And there are some people telling me I was out of my mind to say that Microsoft could go down. It's such a great company. Yep, it is a great company. It is not any less of a company. It just had gotten way too far ahead of itself. Its stock had gotten way too far ahead of itself. And the same thing happens in the other direction. When the baby gets thrown out with the bathwater, it'll become very, very cheap. It'll be a great time to buy Microsoft. However, there will also be some stocks whose aren't that great companies. I mean, they're not, they're still okay. They're not like they're going to go out of business. Obviously, a company's going to go out of business, the stock will go to zero. But you'll have some very mediocre companies, but their stocks will get so cheap and say, I don't care. No, it's not a great company, but its stock is so ridiculously cheap, we can still make 200 or 300% in the next 2 years in the stock. Those are the types of situations that arise as well. We look at companies, but the important thing is to look at the stock in relation to the company. What does that tell you? And that's what we're always trying to do. Too many people focus too much just on the fundamentals when they don't really, it's when they're not really looking at the stock price, and then they come up with their own reasons to justify the value, the high valuations, because that's what works for them. But that's we're in the business of trying to keep things as honest as we can. And again, people aren't dishonest. It's just that they're constantly pushing. I mean, it's the salesperson who's selling their product, and
nobody believes CNBC, Matt. So, but we love you here. So let's go back to the YouTube chat and Stink Face. They're getting a beating these last couple of weeks. Chris G, what will happen to the U.S. dollar? What do you think, Matt?
Okay, well, this is a very interesting one. The dollar will very likely go higher over time. However, I think it's going lower near term. And the reason for this is, look, see how overbought it got? Remember, it's RSI chart that we talked about. Okay. That's its daily RSI chart. Now, look how overbought it is on its weekly RSI chart. So it's getting back up near this level. Okay. Now let's see if I can pull it up. This is I'm going to get rid of these. Those lines, bang. Let's see, and we're going to pull up the, Bollinger Bands charts. Didn't work. Okay, let me try it again here. This is DXY, it's the dollar index. But you see how it got right before Thursday when it came back down. It got above that line that's telling you that it's getting more than 2 standard deviations above its 20-day moving average. Again, these are the type of indications. Now, and the last thing is looking at a sentiment reading of futures traders, and 95% of them were bullish. 95. There's nobody. Everybody owns the dollar. Everybody's long the dollar. Everybody's short the euro, which is the biggest part of the DXY index. Everybody hates the euro. Everybody's short the euro. The euro's oversold. Everybody loves the dollar. Everybody's long the dollar, and the dollar's very overbought. Near term, I think over the next week or two, we're going to see this kind of pullback here that we saw here. It doesn't mean that the dollar or the rally in the dollar is over, but it does tell me it's just too many people on one side of the boat. So this is bullish for commodities, which of course have come down quite a bit, and we'll see what happens to the overall market. There is a correlation between the stock market and the dollar, but it's certainly not a perfect one. And we certainly have seen times when both the dollar and the stock market have moved in different directions. So my point is, and plenty of time where they moved in opposite directions. But the point is that the dollar can come down and the stock market can fall at the same time. But We'll have to see how that works out. But right now, even though I think the dollar is going much higher over on a intermediate and long-term basis, I'm looking forward to pull back here over the whether it's starting. You see, it got hit on Friday, not a big deal. But if we see downside follow through early next week, that'll really give me a lot of confidence that this trade's going to this dollar is going to pull back over a near term, and we actually have a bet against it in one of my in the chat room picks that I picked on Friday. We'll see how it trades. We may if it's not working early on Monday, we may back out of it and wait for more signs that it's going to go down. But right now, it's very ripe for a pullback.
Right. And quick question here. Matt's P&L for the chat room. Matt, you don't mind telling them what the P&L for the chat room is?
Well, we're up. I mean, I say so. We're up. I mean, for the the trades are up. The portfolio is up over for the trading room is up over 500%.
Perfect. So Andy Turner, I love you, man. Abdul, there's a bunch of people on the YouTube chat, Matt. I don't know if you're seeing that, but that's Andy Turner, Rodrigo, Gary Kissel has you. Okay, so we have an interesting question. So Gary Kissel is asking, has you reached an oversold level? You is like, I mean, it's a software company. It's like a typical art company.
Funny. Unity software. Hold on.
And I definitely want to get your take on art, Matt.
Yeah. Okay, letter U. The thing is, it's nowhere near as oversold as it was back in May, and it's been trading in this kind of sideways range. So this is one of those where, once it breaks out of the sideways range, it should move in a significant way. That's whenever the longer it goes in the range, the bigger the breakout, and it usually sees a further move once it in the direction of the break. Now here, what we're looking at is it can't get above its 200-day moving average. It's not as oversold as it was back in here, which really, got extremely oversold, looked like a great opportunity to buy it, and it did. That doesn't look like much of a move, but over a short period of time, that's a 42% move. You make 42% in the stock, those options are going up several 100%. So again, I'd like to see it a little bit more oversold. If it breaks above that 50-day moving average, it should run. So, but it won't. Again, you always have to be careful. If it breaks slightly above it, that's not going to be enough, because that won't be enough to take it out of its sideways range. But I will look at one thing here. The weekly chart. Yeah, in the weekly chart, it's again, it's kind of range bound. It could be one, again, for a really short-term trade. It looks like it could bounce a little bit more, but right now, this is something where I would either like to see it get more oversold again or break above its 50-day moving average before I'd want to make a play, because it's been, again, stocks, until they move out of those sideways ranges, they just tend to be in those sideways ranges, and that's really tough to make money in the options market, especially in the options market, because then the time value just eats away at your holdings. And then if you mentioned ARK, again, Kathy Woods, very, very smart person. But again, my fear is that she didn't realize that the liquidity played so much more of a role in this rally here than she realized. And it's trying to base. I just don't. The stocks she owns are still expensive, and since you're betting against innovation, no, I'm betting against them adding a massive amount of liquidity again. That's what I'm betting against by betting against ARK. I think that it will at some point, if those innovative companies will do really, really well, but they won't do as well. Their stocks won't do as well as quickly as they did here, because this was massive liquidity being provided into the system, and a lot of it went into the economy, a lot of it went into the market, and when it went into the market, it went into those things that were really momentum names, not because they were so innovative, because they had the right momentum, and we know what happened. All the individual traders came in and bought it stuff. So it's until the bear market bottoms, which I don't think will happen for a while. I'm gonna be staying away from ARK. And of course, they have SARK that a lot of people like to buy from here from time to time. But again, it was a liquidity-driven market, and I mean, everybody. It was kind of funny because everybody knew that in the summer of 2020, that the market was way above the fundamentals because the economy had basically completely shut down. So they just felt, okay, well, eventually it'll catch back up. The problem is they didn't pull away the liquidity, so it was here. It could never, it caught up some, and then it could never fully catch up because that liquidity was still being provided. So now the liquidity has been taken away, so it's coming back down. The problem is that the economy is turning down, so it's got to go like that, and that's really what we're looking at. A couple of things just to think about for this week. We have, because we got some key earnings coming up this week. One of them is going to be Halliburton. Okay. See, the stock has obviously gotten below its 200-day moving average. It's quite oversold. Okay. Now it's been oversold for a while, but they report on Tuesday. That's going to be one we're going to look at the long side. We'll make the full determination later. You can see it's not wildly oversold on a weekly basis, but it is on a short-term basis. So I guess my point is that one of the groups that that everybody's been saying that's going to do well during this earnings season is the energy sector. Well, the group is not, but that would be like, yeah, they're going to have good earnings, but the stocks are all on their highs. Well, that's not the case at all. These stocks are all gotten clobbered lately in the last 6 to 8 weeks, or last 6 to 7 weeks. So they're starting getting ripe for bounces. They're getting oversold. So if they do report good earnings, that could be a nice catalyst, especially if the dollar rolls over a little bit on a short-term basis. Lower dollar is positive for commodities. So these are the types of things we'll be looking at this coming week. And we got a lot of earnings coming out, not just this week, the following week, next 3 weeks, really. But we have Baker Hughes is as another driller, another oil driller that reports on Wednesdays. Halliburton on Tuesday. Right. Baker Hughes on Wednesday, and we're going to have a bunch of other names that'll be. I'm just looking at my list here this week. American Express later. Schlumberger, which is another energy name, and then also it'd be interesting to see Freeport McMoran, which again is a copper name. Copper's been under a lot of pressure. If the dollar can rally, if the dollar rolls over, maybe copper can bounce back. It should be, but these are more short-term plays. But sometimes you get these really, really good situations. I mean, you saw with earnings, and you'll be able to play them on the correct side. The bank stocks report next week. We saw a big bounce in Citigroup. Their earnings really weren't particularly good. They did beat expectations, but the stock had huge short interest. And so when the stock didn't get hammered right after they reported, those shorts started covering and the whole thing fed on itself. The stock was up 13% in a day. And Citigroup, I can't remember the last time Citigroup was up 13% in one day. That was this artificial short squeeze. So some of those banks may be good times soon. I can't look at that. So let me just turn that off. Sorry. So that's what we're looking at. So next week's going to be a very interesting week for individual names. It's going to be a very interesting week for the stock market, as I talked about. Remember that 3,900 level. That old support is now new resistance. Can we break back above it, or do we fail? That's going to be very, very, very important.
Right. Well, look, Matt, I mean, you've been doing this for 40 years. Everybody loves you in the chat room. Can you give us some insight? Because there's a lot of people that unfortunately or fortunately like crypto. What is your professional opinion as an equity strategist about Bitcoin, considering everything, Matt, considering everything that's happening with Celsius, everything that's happening over there, considering the retail guy, right? Because that's who we are for. We're for the retail guy. What are your thoughts overall, like 100% honest, right?
Yeah, I think they'll do fine over the long term, but I don't like them near term. I just think there's too much uncertainty. There's and one of the key things about uncertainty is we just don't know how to value these things. One of the things that we have to worry about is that the governments really they have very few real powers. One of the very few powers they have is control over their currency. So for these cryptocurrencies to work, these governments aren't going to allow them to work the way that some people, like the CEO of MicroStrategy, keeps saying that we can have all. It's like the powers that be want to make sure you don't get that kind of freedom. That's their whole. That's if they have that kind of freedom, that takes away too much of their power. And you know how those people in power love power. So I'm not going to turn this into a big conspiracy thing. I'm just saying that and plus the whole big crash means you're going to have a lot more regulation. That fits into what they'll be able to do. But once it gets into once it finds the level and we get a real idea of what these things can really do, it should do really well. But I just don't see that being at 20,000 on Bitcoin. I think it's going to be somewhere, closer to 10,000, below 15,000. So I'm not one. I'm not going to back up the truck here. I think that was pushed way too much by the amount of liquidity that was in the marketplace from March 2020 until the end of last year, and now that the liquidity is disappeared, and I don't think going to come back soon. It's going to be tough for these cryptocurrencies to avoid falling further at some point. And the other thing too is that we're not going to have 900 cryptocurrencies. We're not going to have 90 cryptocurrencies. We're not going to have 9 cryptocurrencies. Okay, we might get 5. Okay, so you have to be very discriminating when it happens. Figure out what the ones that are going to survive, and it's just very tough to do that in this time frame. There's too much uncertainty involved. So I'm still kind of staying away from the from this asset class right now. Not calling for the end of the world. I'm not. Warren Buffett thinks they're worthless. I don't think so. I don't think that's the case. But I do. I definitely have. I'm not putting any my money into it now, I guess is my point.
Right. Okay. Well, personally, Bitcoin, in my personal opinion, is going to zero. We have Andy Turner asking about PAR. Good friend. Andy Turner is I don't know if he's a member of the chat room, but he's definitely been active. So let's just kind of switch over, Matt, to let's just get tickers from the chat and give your full opinion. By the way, folks, so
On PAR technology?
PAR, yeah. So whenever Matt talks about a stock with all the members, he gives an honest opinion, an honest trade, if there is a trade to be made. But let Matt.
Yeah, I hate to say it, but I'm decidedly neutral on this thing. I pulled up the. I just wanted to see where it was trading. Let me do it again real quick. See what its valuation here. Yeah, so there's no earnings. So it doesn't have a price earnings ratio because there's no earnings, but that's okay. But I mean, there was a time when Apple didn't have any earnings. So, but I'm decidedly neutral on a technical basis. I mean, look at this thing's been stuck in a wide range, but albeit in a range. And let me get rid of some of these lines. See the 100-day moving average here. They haven't. You can see it hasn't really stopped or. Well, I mean, lately it's been using the 50-day moving average as a support level. So I'll get rid of those. You can see it's bounced off its 50-day moving average here. That's the yellow line. Bounced off it there, bounced off it there. So if it finally breaks below it, that's going to be a problem. But you can see the RSI is very, very neutral. It's sitting in the middle of a very, of a range. It could be looked upon as a, let me take this out. I suppose you could say that it is a, we say a symmetrical triangle pattern that it's making here. I blew it. But if it breaks out of that could be a compelling move. But for me, it's just like when it's been trading relatively in a relative range for a while, I worry that it's going to continue, things can continue trading in a range for a long time. And if you're just buying the common stock and you like it on a long-term basis, that's okay. You can just say, hey, I'm just going to hold on to it for a while, and that's great. If short, I don't short things. That's just very, very risky. But I can buy puts. But until this could be seen as a symmetrical triangle pattern. So at the very least, I'd want to see a break above 40, above this high, or break down below this, but which was also, remember, the 50-day moving average. But until that happens, I'm just not going to I wouldn't make a play on the stock. I just want to hold off. It's just, it's just not enough movement, not enough volatility for me to get too excited about it. And that's, again, I'm just trying to be honest. If sometimes you sit there and you say, when people are asked on CNBC about a stock and they have to have some sort of, I either love it or I hate it, or at least I like it somewhat, or I don't like it. This one, I mean, I just don't. It's just not one. There's too many other opportunities out there on either side, the long or the short side, for me to really want to make a big bet on this name right now. But at least the battle lines are well drawn. You see, once it breaks, if it breaks below that 50-day moving average, it's going to be, and again, I'll pull that back up. That that 50-day moving average is going to be something you can look at some negative bets. What's wrong with this thing? Well, I can't bring it up. I'm sorry, but anyway, let's see here. My screen's kind of freezing up there, but again, that's my honest answer to it, is that I on a short-term basis, I'm not overly excited about it, and until it does something, it's going to be it does something. I'm going to let the stock tell me what it's going to do next, rather than just trying to guess, because it's just everything about it right now is very, very neutral.
Right, right. And folks, by the way, I don't know, from what Derek is telling me on the YouTube chat, it looks like the YouTube, for some reason on the Zoom, you guys cannot chat. So if you have any questions for Matt, put them out. But let's go ahead and just get on with the session here. Matt, before we do get into tickers, I know you're gonna want to get into Tesla.
Yeah, I mean, it's funny because they do report. I was make sure, because I had it down. Was it Tuesday or Wednesday? Wednesday. Yeah, they report on Wednesday. So, I mean, obviously, this whole thing with Twitter has been been a shit show, and it's just going to be tough for the stock. I mean, you can see what's happened since the announcement. The stock has been stuck in this range. It's another one where it's it could be seen as a symmetrical triangle pattern. You don't want to bet against Elon Musk. But I guess my point is, I just worry that this Twitter situation is going to be there for a while. It's going to take him away. He's been concentrating on too many other things, and that's going to cause some problems. So I'm not a big bull here on near term. And of course, it's a market stock, and so if the market goes down like I think it will, this stock is eventually going to break down, in my opinion. It's just, you look at the trend lines here. Let's just see. Obviously, it's gone way below its trend line, going back to the lows back in 2020. It's been trading below that for a while now. You can, however you want to draw it, there's many different ways you can draw it, but no matter how you do it, I can put it there too. Either way, you see it got up to its trend line. If you draw it another way, if you drew it like this, right there, bang. See how it got right up to that trend line and then failed until it gets above that, until it gets above 800. And I just don't see that happening in a big way, given what's going on with this whole Twitter fiasco. And people, I'm not overly worried that they're starting to lose market share. But when you got 95% market share, you're going to start losing it at some point. We always knew that. But the thing is, the market is growing in a major, major way. So the fact that they're losing market share doesn't mean they're going to that their earnings are going to go down, or they're not going to make a lot of money going forward. But I just think this Twitter issues, and the fact, I'll go back and blow it up here, so you can see that it's already well below. It hasn't really made a serious attempt at trying to get back above those trend lines. Let me just pull it back up again.
Right.
And so I'm going to kind of, it's actually good, because I think the stock, if it breaks down here below these lows here, there's people thinking that have targets of $450. I don't think that's out of the question. So I'm leaning towards the bearish side. I don't have any position in it right now. But again, going back to the thing, if it breaks down below this symmetrical triangle pattern, and which I think is very possible given the issues he's dealing with in terms of. See the bottom line. I'm going to draw the top line real quick, but the
Right. So Matt, you've been here with us for like a couple hours. So do you have any? Well, let's go over a couple tickers here. It looks like Matt, can you please elaborate what we were talking about earlier session about liquidity crisis? Someone's asking about the liquidity crisis, Matt.
Well, I mean, yeah, okay. So there's two things going on that's hurt the liquidity. Okay, when the Fed had provided all this liquidity through their QE program, and not to bore you to death on how that whole thing worked, but what you had is that the banks would go in, and when they have these, we have member banks, what they call, there used to be 39. I think there's about 28 or something now. But these banks were the members of the Federal Reserve bank system, And whenever the Fed comes in and buys or sells treasury securities or mortgage-backed securities from them, those banks have to do the opposite. So if the bank comes in and says, the Federal Reserve comes in and says, we are buying treasuries from you. And they go, okay, well, we have to try them. So they sell the Fed the treasuries, and that was that whole QE program. And so, of course, the Fed pays for them and gives the banks money. What does the banks do? What does the bank do? They help the economy. They help the system stay liquid. They help put money into the economy. But they also have, if there's an excess, it goes into the markets because they can just sit on the stuff overnight and keep doing overnight repo and stuff. Or they can invest it, and that's what they did. And they pushed asset prices higher. But not only that, they went out and they said, hey, the private equity firm, take a bunch of our money and invest it. Hey, a venture capital firm, take a bunch of our money and invest it. So all these new startups come along, and everybody's making lots of money, and everybody thinks they're richer than they really should be, because they really shouldn't have got as much. The private equity firms got more money than they should have. That means they're giving it to more startups than they should have, and the whole thing feeds on itself for a while. Well, when the Fed clamps down on that, so now they're not buying through QE, they're shrinking their balance sheet. So they're going into them and saying, okay, we're selling you. We are now, we are now selling you the bonds. Okay, so you have to buy the bonds. You have to give us the money. So that takes the money out of the system. That takes liquidity out of the system, and that's what they're doing right now. So they're shrinking their balance sheet, and of course, raising interest rates causes problems as well, because it makes it harder for people to borrow. Now, the other liquidity crisis that we have is that within the marketplace, because market makers, since these banks and brokerage firms aren't getting as much money, they don't have as much money to make markets. So when especially in the fixed income markets, they will come in and you have buyers and sellers, but there's a mismatch sometimes. So the broker, the Morgan Stanleys, the Goldman Sachs, the Merrill Lynch's of the world, or Bank of America Securities, which I guess they go by now, these companies, they fill in the gaps. But they're like, their bosses are saying, hey guys, we're not giving that much liquidity to the system anymore, because the Fed's not providing with as much liquidity, and there's so much violent moves, we're losing too much money by providing that liquidity. Because when everybody wants to buy at the same time, selling is usually the wrong thing to do. We're selling to help the market stay liquid. That's no good. It's a losing picture. So we're losing liquidity from the Federal Reserve, and we're losing liquidity from market makers because they've lost too much money this year, and they don't want to continue losing money. And so those who are in charge of their P&L and and how much money they can, how much liquidity they can provide their customers, are pulling in their horns in a big way. So that's what's going on there, and I can see that continuing through the rest of the year.
Interesting. Matt, what are any closing remarks that you have here, not just for people that want to join the chat room, because ultimately you're trading day and night, but for the folks that want to get into the chat room, not only know what's happening, but how to make money out of it? Any closing remarks?
Well, just that again, that the volatility is here. And it's going to remain here. It's been here for all year. It's going to remain the rest of this year. Sure, maybe in the last week of August or something, things will calm down a little bit. But once we get right back in after Labor Day, it'll pick right back up again. And it's going to be that. And I think it's going to be more than just the next 6 months. But the biggest thing is we have the tools where we can take advantage of it. For years in the past, only institutions had that. And not only can we make downside bets much easier, but we can also make the downside bets were very, very difficult to make because you could buy quarterly options. They went out 3 months. It cost a fortune. Now they have weekly options, but you can also make it to the upside because of those weekly options. It's like, hey, geez, I really like Apple, but I got to buy, but I think it's going to go up over the next 2 weeks. But I've got to, but their next options only expire 2.5 months from now. I got to pay a lot of time value for that. So, man, I'm just not going to make as much profit. Where now you can say, I really like Apple Computer. I'm just going to buy their options that expire in 3 weeks. I won't have to pay as much time value. So my much more potential profit, but in both directions, up and down. And as I showed you earlier, we've done it in several different, whether it be ETFs or stocks. We've made money in both directions. And when you have the volatility we've had, again, you got to go by. It's more. We got to look beyond the fundamentals. That's where the money's being made. It's going to be that way for, I think, for at least another year. And even as we get past that, all of these issues, these traditional things, but everything just goes straight up. We're going back to having to trade and invest in a way that is more based on reality, not on this steroids that we've been using with the Fed. And getting off those steroids is going to be painful for a longer period of time. It's just it is. I mean, it's just like a drug addict or whatever getting off the drugs. It's a painful process. It's the right process, but it takes time. And that's what we're going to do. And we're going to take advantage of it. My point is, there's so many times we want to help you weather the storm. We want to do way more than just help you weather the storm. We want to help you profit from the storm, because when there is going to be an unbelievable buying opportunity at some point, like it was in 2003 and there was in 2009, the markets may not fall that far, but they're I think, going to fall further. And when you have that, if you've been the one losing money all the way down, you're going to say, just get me out. I never want to look at stock market again. We'll be the ones that have made money on the way down. We'll have money to invest, and we'll have the confidence to invest it. And that's, confidence is such an important aspect of trading. So that's what we're looking for. And so I hope you'll consider it. You get there's a money back guarantee. So if it doesn't work, doesn't go to your liking, you can always bail, and it's fine. But it's worked out pretty well for us this year. It's going to continue to do so, and I'm really looking forward to a lot more opportunities. Good luck the rest of the year. Have a great rest of your weekend, and we'll talk to you real soon.
All right, Matt. Well, thanks a lot for being here. Shout out to Matt Maley, Chief Market Strategist, lead trader at the Benzinga Stock Picks Inner Circle chat room.
Thanks a lot.
My best friend. I love this guy. Matt is top dog when it comes to trading. Folks, if you have not even come into the chat room, you have to do it. Literally. 7-day money back guarantee. If you're not doing it, I really don't know what you're doing. I legitimately don't know what you're doing if you're not coming into the chat room. So I'm going to leave the link in the chat. Derek, I didn't, from what you said, Derek, I don't know how the Zoom is structured, but it looks like the chat is fine, Derek. But for those that are coming in here, just know the offer is only available till midnight. So Matt Maley, 70% off till midnight. All you guys take advantage of it. You got a 7-day money back guarantee. There's literally no reason why you shouldn't try this. So I love you guys. I will see you next time. And for the folks that joined, I will see you in the chat room tomorrow on Monday.